By using the suggested work method, we were now able to identify the business combination valuation journal required for the 20x10 reporting period. That was a debit to the revaluation deficit through profit and loss of S, and the credit to revaluation surplus at, where we created this new equity item for the subsidiary. So this will now become your first consolidation journal entry. After this, you have your at acquisition consolidation journal entry, where you eliminate the share capital and the retained earnings, but now you also eliminate this 20,000 Rand that you have created through a consolidation journal entry with a debit to the same account. This is now the total equity of the subsidiary at acquisition date. That eliminates against the investment at cost, which is the 120,000 Rand on the trial balance. And now we have to measure NCI. This is new in this example. According to the additional information, NCI is measured at their proportionate share of the net assets of the subsidiary. Let's see how this 30,000 Rand was calculated. It is calculated as 20% of the net assets of the subsidiary at acquisition date. From the accounting equation, equity equals assets minus liabilities. So the total equity at acquisition date represents the net assets of the subsidiary at that date. The 122,500 Rand was given as share capital and the 7,500 as retained earnings. Because we created this equity item of 20,000 Rand, the at acquisition equity of the subsidiary increased with a resultant increase to the land. This happened at acquisition date, and that will remain the at acquisition equity of the subsidiary regardless of what happens to the underlying asset, being the land. If this 20,000 Rand was not added to the net assets of the subsidiary, NCI would have been calculated at an incorrect amount, and you would have had incorrect goodwill or gain from bargain purchase. That reiterates the importance of this at acquisition business combination valuation journals required in terms of IFRS 3. The purpose of the since acquisition consolidation journals is to measure my NCI since acquisition date. This is where we identify the equity items of the subsidiary, the movements in it since acquisition date, and where we attribute a portion of that to NCI for purposes of measuring the equity in the group. In Journal 3, we attribute a portion of the since acquisition date retained earnings opening balance of the subsidiary to non-controlling interests. My starting point is the trial balance retained earnings opening balance of S. Then I asked the question whether there was any consolidation journal entries that changed this retained earnings opening balance of S. That is then taken into account in this calculation before I attribute. The only consolidation journal entry changing the retained earnings opening balance of S is my Journal 2 through the at acquisition elimination journal entry. This now leaves me with the movement in the retained earnings since acquisition date, and that is attributed at 20% to my non-controlling interest opening balance. Journal 4 attributes a portion of the subsidiary's profit for the year to NCI. My starting point is again the trial balance profit of S. Please remember the 110,000 Rand was given as profit for the year, and the current year revaluation deficit through profit and loss was given as a separate line item. Therefore, these two amounts netted off represents the TB profit of S. In the current reporting period, being 20x10, there was an additional revaluation deficit of 20,000 Rand necessary from a group perspective. This relates to an asset owned by the subsidiary. As my non-controlling interests share in the movements in the net assets of the subsidiary, this 20,000 Rand should be taken into account when calculating the profit attributable to non-controlling interests. There was a consolidation journal entry through Journal 1 where the profit and loss item of the subsidiary was changed. Furthermore, that Journal 1 results in a change to the group's profit and specifically the profit of the subsidiary that is included in the profit of the group. Consequently, the calculation of profit attributable to NCI has to be affected by this journal. Please refer back to the principles from Chapter 4. After the trial balance profit has now been changed with the effect of this consolidation journal entry for 20,000 Rand, can you attribute a portion of that to my non-controlling interests? Let's now have a look at the consolidated statement of financial position at 31 December 20x10. Next to the property, plant and equipment line item, I apply my basic principle, 100% P plus 100% S. Here you can now see that I'm not changing the land, which is measured at 65,000 Rand in the separate financial statements of S for group statement purposes. That is also the correct value in the group. Other assets, I add 100% P to 100% S. The equity section I will discuss as part of the statement of changes in equity.